What is the data really saying? Welcome to Chart Watch, where we break down a few key charts and explain the story the data is telling about the economy and long-term investment trends.
Hi, everyone. This is Tom Siomades. I'm Chief Market Economist here at AE Wealth Management. And I know there's a lot going on with Iran out there. And I wanted to point out on the monthly chart book something that you can use with clients when discussing the situation over there. So if you look on page 2 of the chart book, at the bottom right, there's a chart of oil prices. Okay. And it's important because here's a blow up of it is oil prices have gone crazy over the course of March, right? So no surprise, gas is up $1 all over the place. Now we're almost getting to sort of the same recent record territory that we saw when things were going on in Ukraine in 2002. Okay, so what's important about that people need to understand is that we're in a sort of strange place when it comes to the traditional relationship that exists between bonds and stocks. And what's interesting about that is as we discuss, even though the market does perform well over time, we're kind of one of those weird places where diversification isn't necessarily working in the traditional form. And what I mean is that typically when when stocks go down, people run to bonds for safety. Okay, that's usually the case. But in this particular case, the situation is such that because of the inflationary pressures that higher energy prices create, it sort of breaks down that relationship. And what that generally creates is an environment where the traditional diversification play doesn't exist. Stocks go down, bonds go down. Why? Stocks go down because energy prices increase business costs, people start spending less money, profitability suffers, and then so forth and so on. Business conditions deteriorate. On the bond side, bonds are freaked out because they think that higher oil prices are going to create higher inflation. And if you have higher inflation, why do I want to get a 5% bond today when I could just wait with inflation being higher and get a 6% tomorrow? So that's kind of what the problem is there. So what that does is that opens up a situation where the same old playbook doesn't work. But what happens is it opens up a situation for you to maybe perhaps use some alternatives. And it could be a lot of things. It could be, precious metals. It could be managed futures. And I'm sure you could talk to your advisor or your VP at Wealth Management here that can get the right situation for the right client. But just be mindful, oil prices aren't just reflected in higher gas prices. It does trickle through the economy, and why the normal process that you may have been trained to see isn't happening because of oil, where stocks go down and bonds don't protect you all that well. They go down as well. So hopefully that helps. But again, we'll get through this thing. And as I showed you before, look at markets are always in crisis. Things are always going on. And at the end of the day, frankly, listen, we're going to be further ahead. If anyone here believes that the market's not going to be higher 3 to 5 years from now, maybe you shouldn't be in the stock market. But I think at the end of the day, this is another one of those examples where, short-term anxiety will lead to, hopefully if you're calm and follow your plan, will lead to long-term success. So thank you very much. Have a great day.